Thank you once again, friends. This is none other than your host, Mr. Spotter Fred. We'll continue with what we have been doing in respect to financial reporting as far as consolidation or group accounts, call it business combination, is concerned. Now remember, friends, we have been looking at various elements or aspects of consolidation from lesson 1, lesson 2, lesson 3, lesson 4, lesson 5, lesson 6, lesson 7, lesson 8, lesson 9. Now we are in lesson 10, and I know you are getting the concept of consolidation. Now remember, from the previous lessons, we have been looking at the introduction of consolidation. We have seen various, and at every lesson, we have been advancing and developing this consolidation further. The most recent lesson, we talked about mode structure. And in mode structure, remember, we are talking about group accounts. So in mode structure, we say that there are three. We have horizontal, we have horizontal structure, we have the vertical structure, and we have the mixed structure. This is what we looked at in the last lesson. Now today we want to look at an illustration. We want to look at illustration in respect to horizontal structure, and this is our illustration number 11. We have done illustration number 10, remember? So this is our illustration number 11. Illustration number 10 was bringing in the concept of goodwill and intercompany dividend, and we looked at some good other elements or aspects of consolidation. This illustration number 11 will want to look at how do you approach our horizontal structure. Then we also want to look at, maybe in the subsequent scenarios, we'll look at the element of vertical structure and as well the mixed structure. Now, in our illustration 11, that we want to look at the concept of horizontal structure, whereby you have one holding company and several subsidiaries. So we can read this. The following are the balance sheets of the two companies, that is Tamim, Mima, and Pesaflow Limited, as of 31st December 2015. We have the non-current assets, as you can see. We have the property, plant, equipment. We have the investment in Mima Limited. We have investment in Pesaflow Limited, and we have the current assets, inventory, accounts receivable, cash at bank. We have the total, we have the equity liabilities, capital reserves. To start with is owner share capital. We have the 10% preference share capital. We have the share premium. We have the retained profits, and non-current liabilities, the 10% debenture. There's a 15% redeemable preference shares. We have current liabilities, accounts payable, and we have the taxation. So total equity liabilities, as you can see, we have it there. Additional information. 1. Tamim Limited acquired 70% owner shares of Mima Limited on 1st October 2005, when the retained earnings was 40,000 shillings, and also 65,000 of owner shares of Pesaflow Limited on 1st January 2011, when the retained earnings was shillings 30,000. 2. Tamim Limited acquired 20% preference shares of Mima Limited on 1st October 2010. 3. Tamim also acquired 40% debentures in Mima Limited on 1st January 2015. 4. During the year ended 31st December 2015, Tamim Limited sold raw materials to Mima Limited for 200,000 shillings, making a profit of 25% on costs. 1/4 of these raw materials were included in the inventories of Mima Limited as of 31st December 2015. 5. Included in the trade payables of Pesa Limited and accounts receivable of Mima Limited as of 31st December 2015 was 80,000 shillings, representing the indebtedness between the two companies. 6. At the date of acquisition, the carrying amount of an item of plant in Pesa Limited was 40,000 shillings. Below its fair value, the item of plant had further useful life of 10 years on the date of acquisition of Mercury Limited. 7. Is the policy of the group is to test impairment on goodwill at 10%. Required, prepare consolidated statement of financial position as of 31st December 2015. This means that from the required point of view, our financial year begins 1st January and ends in December. So the current financial year we are dealing with is the 1st January 2015 and ends on as of 31st December 2015. Now, friends, as you can see from the additional information, number 1, we have been told that Tamimu Limited acquired 70% shares in Mima Limited. So Mima is a subsidiary of Tamim. And on 1st October 2005, when the retained earnings was 40,000. Now, friends, this 40,000 is simply the pre-acquisition retained earnings. The retained earnings existing at the date of acquisition. The cumulative retained earnings at the date of acquisition is a pre-acquisition retained earnings which will be used to determine goodwill. And also, it also acquired 65% owner shares of Pesa Limited. Remember, they have acquired more than 50% in Pesa Flow Limited. That means that both Mima Limited and Pesa Flow Limited are all subsidiaries. And now that takes us to the horizontal structure. We have one holding company being Tamim Limited, and we have 2 subsidiaries. We could have add more. We could have had even 3, 4, 5. That's no problem. So we have been told ordinary shares of Pesa Flow Limited on 1st January 2011. When the retained earnings was 30,000. So at the date of acquisition, the retained earnings of Pesa Flow Limited was coming to shillings 30,000. That is interesting. Then we have been told number 2, Tamim Limited acquired 20% preference shares in Mima Limited on 1st October 2010. That's perfect. That we have also acquired, other than acquisition of owner shares, they have also acquired preference shares. 3, Tamim also acquired 40% debentures in Mima Limited on 1st January 2015. So that means apart from acquisition of owner shares, they have also acquired the debentures. During number 4, during the year ended 31st December 2015, Tamim Limited sold raw materials to Mima Limited for 200,000 shillings, making a profit of 25% on costs. 1/4 of the raw materials were included in the inventories of Mima Limited as of 31st December 2015. So this is an intercompany trading. An intercompany trading on raw materials from one group member to another group member, and the selling price was 200,000. But these goods, these raw materials were sold at a profit of 25% on costs. If they say 25% on costs, then automatically that means that is a markup. So the markup given here, friends, is 25% on cost. And if the markup is 25%, then the cost price is 100%. That means the selling price is 125%. Simple. So we can easily determine the total profit. Then out of the total profit, there is a profit which has not been realized. That's one alternative. The other alternative is simply to convert the markup to the margin. If a markup is 25%, it's just like a quarter. That's 1/4. What will be the margin? The margin will be 1/5. So that is like 20%. So if you use a margin, to determine the unrealized profits, you simply take the margin, you multiply the selling price of unsold or unused raw materials. So in this case, we can say 20%, you multiply the 200,000, you multiply their quarter, you get the figure that you need. Alternatively, you use that markup. Because we have said, if you have been given 25% on costs, then that's a markup. If it was 25% on selling price, that could be a margin directly. So if you have been given a markup of 25%, the cost is 100%, then the selling price is 125%. You can start by determining the total profit, which will be, like in this case, the total profit will be 125% is equal to 200,000. So you come and say about the 25%. 25% you multiply by 125, you divide it by, you take 25%, you multiply by 200 million or 200,000, you divide it by the 125. What you get there is a total profit of 40,000, but a quarter has not been realized. So divide by a quarter, divide by 1/4, multiply by 1/4, that's 10,000. So 10,000 is the unrealized profits. That's using a markup. You can use a margin. We say if you have a margin, you take a margin, you multiply the selling price of unsold goods, you get the unrealized profits. So the margin, we said, if you are given a markup of 25%, that's 1/4. The margin is 1/5, which is equivalent to 20%. So we must have talked about those business of margin markup in our lesson 3, 4, somewhere there. So we come and say, the margin is 1/5, which is 20%. You multiply the 200,000, then you multiply 1/4, that's a quarter of the goods that knows me sold, comes to 10,000. That's important. Now, what I'm trying to say is this, if you have a markup, this is A over B, then it means that we have, like in this case is 25%, we have 25%, which is 25 over 100, which is a quarter. And if you want to determine the margin, then it will be A, B plus A, and that one will be 1/4 plus 1, and that is it, 1/5. You need to remember these concepts so that if you are determining the unrealized profit, you simply take the margin. You multiply the selling price of unsold goods, or if you are not using unsold goods, unused raw materials, like in this case scenario. We'll come back to that and use it. Then we move on to number 5. Included in the trade payables of PESA Limited, PESA Flow Limited, and accounts receivable of MIMA Limited as of 31st December 2015 was 80,000, representing the indebtedness between the two companies. Now, 80,000 is simply the intercompany owings that we are going to adjust in our trade payables. We also adjust in our trade receivables. 6. At the date of acquisition, the carrying amount of an item of plant in PESA Limited was 40,000 below its fair value. The item of plant had a further useful life of 10 years on the date of acquisition of Mercury Limited. Now that is the business of revaluation. We need to determine the revaluation surplus, and the revaluation surplus given there is 40,000 because it's the book value. We have been told that the carrying amount of an item was 40,000 below its fair value, meaning the fair value was higher than the book value, that it had not been incorporated in the books. So there is a revaluation surplus of 40,000 which had not been incorporated in the books. We need to recognize it and incorporate that in the books. So first and foremost, this revaluation of 40,000 will be treated as an increase to the PP. We debit our property, plant, equipment, we credit our revaluation surplus. This revaluation surplus is a pre-acquisition item, so you split it into two. There is a group share that goes to the cost of control to determine goodwill. There is the NCI share that goes to non-controlling interest account. Then we'll need to determine whether there is a depreciation over or under charge. Definitely, if it's a revaluation surplus that was never recognized or incorporated in the books, there is a depreciation under charged. How much could be the depreciation under charged? For only 1 year. For 1 year, it could be 40,000 divided by 10 years, because the remaining number of years, friends, is 10 years. So 40,000 divided by 10 years, you get 4. If you get 4,000, then you multiply it for the number of years from the date of acquisition to the date of consolidation to get the total cumulative depreciation under charged. That case, we say 40,000, you divide it by 10, you get 4,000. From the date of acquisition to the date of consolidation is how many years? From 1st October 2010 up to that 1st December 2015. Those are, we acquired, that is 5 years. So if you take you take the 4,000, you multiply by the 5 years, you are getting 20,000. So that is the 20,000 we are looking at. That is, sorry, it's not 20,000. The number of years from the date of acquisition to the date of consolidation, from 2005 up to 2015. Those are 15 years. So 4,000 by 15, we are getting 60,000. So 4,000 by 15 years, 60,000 is the depreciation and a charge. And we are going to adjust it accordingly to our property, plant, and equipment. 60,000 is the total depreciation and a charge. We are going to make that adjustment. Then we have number 7 is the policy of the group to test impairment on goodwill at 10%. That is perfect. So if you are going to determine goodwill and we have goodwill, then we must adjust it by the impairment if it is a positive goodwill. Now there we go. So we can start in this business. We can even start with the structure. We can start with the structure here. Yeah, the analysis 1, the structure. We realize that this is Tamim. Limited. Tamim Limited has acquired 70% ordinary shares. Not only that, they have also acquired, note number 2, they've acquired 20% preference shares. Then Tamim has also acquired 40% debenture. And they have acquired this in Mima Limited. Tamim has also acquired Pesaflow Limited. Pesaflow Limited, they've acquired to the tune of 65% ordinary shares. So you realize that now in this case there are 2 subsidiaries. Tamim is the holding company, Mima is the first subsidiary, and then we have Pesaflow being the second subsidiary. So that is horizontal structure. Then we have also been told in the analysis note number 4. Before that, in analysis Roman 2, we have been told the pre-acquisition retained earnings. In Mima Limited, it is Kenya shillings 40,000. We'll use that. In Pesaflow Limited is Kenya shillings 30,000. That is perfect, as you can see there. Number 4, during the year ended 31st December 2015, Tamim Limited sold raw materials. So there is intercompany owing and intercompany trading, where we have the element of unrealized profits. Unrealized profits on closing stock. Unrealized profits on closing stock. You have noticed that we were given a markup. The markup in this case is 25%, which is like a quarter. So if you are given a markup as 25%, then the selling price will be 125%. Alternatively, you can use a margin, or we can say our margin is equals to gross profit over cost of sales plus gross profit. And our gross profit is 1. Our cost of sales is 4 plus 1, we get 1/5, or which is equal to 20%. That's important. We can use that directly. Then we have also been told in note number 5. So before I go there, we know that if you want to get the unrealized profits, you can take the margin you multiply by the selling price of unsold goods, which will be 20% by the 200,000 by a quarter, which is 10,000. or we use a markup. You know, the selling price is 125, is 125%, which is equals to shillings 200,000. So total profit, the total profit reported, this is 25%. What will it be? So 25% over 125 by 200,000, then you get the total profit as 40,000. 40,000. So out of that, a quarter has not been realized. So we have 10,000. That's something that we can use as an alternative. Remember, these goods were sold, or these raw materials were sold from Tamim to Mima. It means it's a downstream transaction. And in that case, it will not affect the non-controlling interest. Item number 5 is talking about intercompany owings of 80,000, which we are going to debit our trade payables, we credit our trade receivables. That's what we are going to do. So meaning we reduce our trade payables, we also reduce our we reduce the trade payables and trade receivables by the same 80,000. Number 6, at the date of acquisition, the carrying amount of an item was 40,000. We have already said that. There's a revaluation surplus of 40,000. It's a pre-acquisition item, and there's a depreciation and a charge, which we talked about. We said 40,000 divided by 10 years, you get 4,000 per annum. From the date of acquisition, which is 2005, to the date of consolidation, which is 2015. So if we count 2005 up to 2015, that's definitely 15 years. That is 15 years. Oh, sorry, that is 10 years. That is 10 years, sorry, it's 10 years. So 10 years is from 2005, meaning we don't want to count the 25, we count the 2006 up to 2015. That's definitely 10 years, not 15 years as I must have said earlier, is 10 years. So you take the depreciation under charge per annum, which is 4,000, you multiply by 10 years, that comes to 40,000. We are going to deal with that accordingly. So that's the position, and we have no other big business. Now we'll want to look at the workings. Want to see the important workings that we'll want to do, and in this case we'll want to determine goodwill, both the goodwill in Mima, goodwill in Pesaflow Limited. Then we also determine the non-controlling interest. We also determine the group retained earnings. So that's important. So let me get rid of this, so that we do some workings. Very important workings that you'll always have to do. Very important workings that you'll always have to do. One of these workings is working number 1. We call it working number 1. Remember, we are dealing with an illustration. Let me also remind you that we are dealing with the illustration 11. We are dealing with illustration 11. And working number 1, the working number 1, this was just analysis, trying to go through the notes and see what is required of us. So working number 1, we need to determine our goodwill. We open the cost of control. The cost of control for Mima. There is Mima Limited. There is Mima Limited. We'll have a cost of control for that. I expect not to have so much because there was ordinary shares, there is preference shares, there is share premium, there is retained earnings. I think those are 4, 5, like maybe 6 lines there. So I'll have this one. I'll have this one in shillings. Then working number 2. Working 2, I'll also have the cost of control. Cost of control, this is in respect to Pesaflow. Pesaflow Limited. Pesaflow Limited. We have the Pesaflow Limited, and this is it. So we have these in shillings, these in shillings like that. So Pesaflow Limited. Then we'll also have non-controlling interest. Let me have it in this side. I'll have non-controlling interest workings, so that we are able to get these items before preparing the financial statements. So Pesaflow Limited. So working 3 we have non-controlling interest, non-controlling interest account. This is what we do. Then I'll also have another working, the group retained earnings, group retained earnings account. That's important. Fine. So these figures are in shillings. 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 I'll start with the cost of investment. There is a cost of investment. Cost of investment being the purchase consideration. Cost of investment for MIMA is 750,000. 750,000. There is cost of investment in Payable Limited, that is 450,000. 450,000. Then we also have the retained earnings balances. Retained earnings balances. We have for MIMA, there is MIMA Limited, and there is Payable Limited. There is Payable Limited. We have the retained earnings. There is 250. Oh, I've left out Tamim. Is important to start with that. So I'll come and say Tamim. Then we have MIMA. Then we have Payable. We have Payable Limited. Then we have this for Tamim is coming to something like we have 250,000. Then we come to MIMA. MIMA is 230,000. Then we come to is 200,000. 200,000. Because of a lot of this, let me correct this one so that we have it clear. So we have Payable Limited 200,000. Fine. Now we are good to go. We start off with these items. We say ownership capital. We acquired the 70% of MIMA. 70% of MIMA, the ownership capital of MIMA is 500,000. 500,000. We also have we also acquired preferential capital of MIMA. Preferential capital of MIMA, and we have that is we acquired 20% of 100. Then we also acquired, if you have acquired ownership capital, we have also acquired reserves. So the share premium of MIMA 70%. What is the share premium of MIMA? Share premium of MIMA is 280. We also revaluation reserve or surplus, which was in note number 6. That is 70% of 40. So we are going to take that into account. Then we also have pre-acquisition retained earnings. Pre-acquisition retained earnings, which is 70% of what we were given in note number 1, and that was coming to 40,000 as well. Now don't forget, other than acquisition of ownership capital, preferential capital, we also acquired debentures. So there is debentures as well. There is debentures, and we take 70. No, debenture in note number 3, we acquired 40%, not 70%. So we come and say 40% of the debenture, and that debenture is 10% debenture, and that is 50. We have 50,000, so 50,000 like that. So then we are able to determine our goodwill. We are able to determine goodwill, if any, as a balancing figure. So this is a balancing figure. So that's what we're going to determine, goodwill as a balancing figure. So I take my calculator and say 70%. 70% of 500. 70% of 500. That's 350,000. 350,000. Then we have 20% of 100. That's 20,000. Then we have 70% of 280. 70%. This calculator seems to be fine. 70% of 280. That comes to 196. Then we have 70% of 40,000. That's 28,000. And this one 28,000 the same. So 40% of 50. This is 20,000. So we are able to go on these items. We add 20, we add 196, we add 28, we add 28 again, we also add 20. That's the total. Then you subtract the 750. 108. So our goodwill in this case is 108. Yes, our goodwill is 108. That's perfect. You can further confirm on that because you can say 350 plus the 20 plus the 196 plus the 28 plus another 28 plus the 20 plus the 108. So we are good to go. Our goodwill is 108. Let's see the goodwill for Pesaflow Limited. Goodwill, we are going to take into account ordinary share capital. We acquire 65%, so 65% of the ordinary share capital is how much? So our ordinary share capital from Pesaflow Limited is 650,000. Fine. Then we are also looking at share premium. Share premium is 120,000. Share premium, 65% of 120. We'll get that. We didn't have preference share capital, but we have redeemable preference share capital. No, if we also don't have redeemable preference share capital in Pesaflow Limited. We have the pre-acquisition retained earnings. This is 65%. We were given that pre-acquisition retained earnings in note number 1 is 30. So 65% of that we are going to calculate that. This one we didn't have so much. We didn't have preferential capital. We didn't acquire that. We didn't have revaluation surplus for Pesaflow Limited. We didn't have that. So we can now get this figure and determine our goodwill. That is important. Determine our goodwill as a balancing figure. So we come and say first and foremost 65% by the 650 we are getting 422,500. Then we come and say 65% by 120, then we have it as 78,000. Then we have the 65% of the 30, we have it as 19,500. So we come and say 422,500 plus 78,000 plus 19,500. We are having 520 and this 450. Now friends, it means we don't have a positive goodwill. We have a negative goodwill. This is an interesting example. This is very interesting and we like this now. That we had a positive goodwill for Mima Limited, but for Pesaflow Limited is a negative goodwill. That means it's a profit. It means that we paid 450 to acquire more. That's interesting. So what will be our negative goodwill? Our negative goodwill will be 70,000. So we come and say negative goodwill. Our negative goodwill will be 70,000. This is a balancing figure, and this will be credited to the group retained earnings. 70,000 is a profit. So we'll come and say there is negative goodwill. There is negative goodwill. Here is a reserve of 70,000. That's so interesting. That's a very interesting, and it's good to have a question like this and illustrate like this to illustrate the positive and the negative goodwill. So we are not going to test impairment on this negative goodwill, but we'll test impairment for the positive goodwill. Fine. We come to non-controlling interests. We talk about the ordinary share capital. You know, there is ordinary share capital for Mima, which will be 30%. 30% of 500. That's it. How about for PESA? For PESA Flow Limited, it's we add 65%, so 35%. That 5% of 650. We are going to take that into account. Apart from that, we have the preference share capital. Preference share capital. Preference share capital is only for MIMA, and that is 80% of 100. 80% of 100. That's it for MIMA. Then we don't have for PESA. Then share premium. Share premium we have for MIMA, and there is for PESA. MIMA is 30%. 30% of 280. So that we get that. Then for PESA, it will be that 5%. To be that 5% of the share premium, which is 120. That's perfect. Then we have revaluation reserve. The revaluation reserve we only have for MIMA, and the revaluation reserve is 30% of the 40, the one for MIMA only. We didn't have the one for PESA. Assets on PESA were never revalued. Then we also had the one for, we have retained earnings, nothing else there. We have retained earnings, retained earnings, retained earnings. We don't, remember, we don't recognize the debentures, the one that is held by outsiders. We don't recognize it, the non-controlling interest. Hope you remember our explanation in the previous lessons. So we have the retained earnings. There is the one for MIMA, there is one for PESA. For MIMA is definitely 30% of the total retained earnings. The total retained earnings for this case is I'm seeing 230. Let me confirm that because of my ink was very heavy there. That is retained earnings 230, true. So we have 230, 230. Then we can talk about PESA. PESA is 35%. 35% of the total 200, like that. So we are able, we are good to go to determining our balance carry down. Balance carry down to be taken to the group statement of financial position. But before that, there are some other items that we're going to determine in our debit entry of the non-controlling interest. But for now, let me work over this. We have the 30% of the 500, that is 150,000, as you can see. Then we have the 35% of 650, that one is coming to 227, 500. Then we have the 80% of 100, that's definitely the 80,000. We have the 30% of 280, that comes to 84,000. 84,000. Then we have the 35%, that 5% of 120, that is 42,000. That is 42,000. We have the 30% of 40, that is 12,000. We have the 12,000. Then we have the 30% of 230. We have the 69,000. 69,000. That's 69,000. 30% of 230. We have the 5% of 200, and that comes to 70,000. 70,000. Because of some ink here, let me write this correctly. Let me recognize that correctly. And I'm looking at this as that 5% of 120, we got it as 42. That 5%, 42,000. Then you can see this one is also not doing well. Let me also write it nicely. The 70,000. This is that 5% of 200, that's 70,000. And the 30% of 280, that is 84,000. Let me write it correctly. Perfect. So we are okay there. But there is depreciation. There is depreciation undercharged. There is depreciation undercharged, which we said was undercharged from 2005 we don't count 2005, let's count 2006 to 2015. Those are 10 years. So 10 years, we come and say it's in the books of MIMA, which we had acquired 70%, so 30% of the total depreciation and the charge, which will be 40,000 over 10 years for 10 years as well. So how much will that be? Definitely that is 40,000. So 30% of 40,000. What are we looking at? 30% of 40,000. We are looking at 12,000. Depreciation and a charge. And the goods were sold from Tamim. The raw materials were sold from Tamim to MIMA. So that's a downstream transaction. It does not affect non-controlling interest. So we can determine the balance carried down. We can say 150 plus the 227,500, 150, just a minute. So we are saying 150 plus the 227,500 plus the 80,000 plus the 84,000 plus the 42,000 plus the 12,000 plus the 69. That looked to be 69. I cannot really, the ink is too much there, but it's okay. Then plus 70,000. So we have 734,500, and against we subtract the 12,000. So that comes to 722,500. That is the position. I will confirm that first. I will confirm before we use it perfectly, because of this ink one, and there is 227.5, there is 80, there is 84, there is 42, there is 12, there is 69, there is 70. Yeah, we are right. So we have 722,500. Then we come to the group retained earnings. In the group retained earnings, there's some items you have already taken to the cost of control. The pre-acquisition retained earnings. Now friends, remember, these are debit entry, and the credit entry we have already put it in the cost of control. In the cost of control. That's the 28,000. So you come and say there is for MIMA 70% of a figure that was 40,000, which we have already taken to the cost of control, and that is the 28,000. We come to PESA Limited, the PESA Flow Limited. We have talked about item already taken to the cost of control. That's the 65% of the 30. 65% of the 30 is 19,500, which we have already taken to the cost of control. Then we also have an item NCI, the NCI share, the NCI share of retained earnings. The NCI share of retained earnings in MIMA. In MIMA, we have already taken 30% of the 230, which we have there as 69,000. Then we have also up for PESA Flow Limited, which we have taken 35% of the 200, and that we have got a figure of 70,000. The unrealized profits that in respect to note number 4 on closing stock. Remember, it was a downstream transaction, so it doesn't affect the non-controlling interest. So the unrealized profits on closing stock. Unrealized profits on closing stock, how much was it coming to? We were given a markup which was 25%, and we were able to convert it to a margin. So either whether you use a markup or a margin, you will get the same unrealized profits, which we must have calculated on the other side, as you can see, of 10,000. So 10,000, because it was a downstream transaction, you don't adjust the group share, you just recognize the full amount. That's 10,000. Then, apart from that, we also had depreciation and a charge. There is a depreciation and a charge, there is a depreciation and a charge. A depreciation and a charge, we have already taken into account the NCI share in the non-controlling interest. This is a debit entry. So we are also going to debit the group retained earnings account with the group share, but the credit entry will be made to the PP, meaning we are going to reduce our property, plant, equipment. So the depreciation under charge, the total was 40,000, but now the group share is 70,000. 70,000 on that 40,000 is 28,000. So we have the 28,000 there. Now then, apart from that, we have also been told in note number 7 about the impairment. Remember, we only had one positive goodwill, which was 108. So there is impairment on goodwill. There is impairment, which is 10% of the 108, and that comes to 10,800. Nothing else. So from there, we are able to get the balances carried down from the group retained earnings. So we have the 250, we add the 230, we add the 200, we add the 70. That is 750. So this side we have 750,000. This side we have 750,000, and this side we are expecting to have 750,000 as well. So we are interested with the balances carried down. The balance carried down to be taken to the group statement of financial position. Let's go to that. So we have the 28,000, then we have the 19,500, we have the 69,000, we have the 70,000, we have the 10,000, we have the 28,000, we have the 10,800. So that is it. So we subtract the 750,000. We are getting 514, 700. 514, 700. That is very important. So we'll take it to the group statement of financial position. Now we continue. We now prepare the group statement of financial position. We now come and say our group statement of financial position, where we have the horizontal structure. We have one holding company and several subsidiaries. So that is what we want to do. We come and say it's Tamim Limited Group Statement of Financial Position. As at 31st October, that first is not October, but that 1st December 2015. We have non-current assets. Friends, non-current assets, we have the property, plant, and equipment. We have the property, plant, and equipment for Tamim, which is 365. We have for Mima 600. Remember, PesaFlow is a group member, so 580. We had a revaluation surplus of 40. We have a depreciation undercharge of 40. That is very interesting that the total depreciation undercharge was 40 and the revaluation surplus was 40. Fine. Then we talk about goodwill. We have goodwill. There is 108 positive goodwill minus the impairment of 10.8. Remember, when I'm subtracting goodwill, when I'm subtracting impairment loss from goodwill, I'm simply crediting goodwill. So the debit entry was to the group retained earnings account. The credit entry is to the goodwill account. So we are going to determine the subtotal figures there. At that point, I'm saying we have the 365, we have the 600, we have 580. So 600, 580, we have 1545,000. Then for goodwill, we have 108 minus the 10.8. That comes to 97. We have 97,200. Then we add 1545. 1545, we have 16,42,200. Then we talk of current assets. Current assets. Current assets, we have inventory. We have trade receivables. We have cash at bank. Then we are able to get this so that we get the total assets. So I'll take my illustration and confirm that. Inventory, we have 150 plus the inventory of MIMA 300 plus the inventory of PesaFlow 250 minus unrealized profits. Unrealized profits was something that we calculated was 10. So we'll calculate that. Trade receivables, our accounts receivable, we have 180 plus the 250 plus the one for PesaFlow 150. Then I subtract intercompany owing that we were given in note number 5, that is 80. Cash at bank, we have 120 plus the 200 plus 100. Simple like that. So 120, 200 plus 100. Let me take my calculator, get those figures first. We are saying inventory is 150 plus the 300 plus the 250 minus the 10. 10 is the unrealized profits. So this is 690. Remember, when I say subtract 10 as unrealized profits, that's a credit entry. The debit entry was made to the group retained earnings account. Trade receivables or accounts receivable 180 plus the 250 plus the 150 minus the 80. Then we have 500,000. 180, 250 plus 150 minus 80. Then we have the 120 plus the 200 plus the 100. So I'm getting the 420. That's perfect. So 420, I add the 500, I add the 690. So I'm getting 1610. Then that's 1610 plus the 1642, 200. 1642, 200. That's 1642, 200. I'm getting 3252, 200. Now we look at equity. Equity and reserves. One of them item is ordinary share capital. The one for the holding company, the holding company has not issued shares any so far, 850,000. We have 10% preference share capital is no longer there. Share premium. Share premium we have 400. Group retained earnings. Group retained earnings 514,700. Non-controlling interests 722,500. So I get the subtotal for that and saying 850 plus 400 plus 514.7 plus 722.5. So I'm getting 2487 200. Then we have non-current liability. Non-current liabilities. Non-current liabilities. In the non-current liabilities, I have 10% debenture. Remember, it had been acquired for the one, especially the one for Mima, had been acquired. So we take the one for Tamim, that is 30,000, plus the one for Mima, 50,000, plus the one for PesaFlow. The one for PesaFlow is 25. I'll subtract what had been the group share, which had been reported in the cost of control. And the group share that had been reported in the cost of control is the 20. So that was 40% of 50. So I subtract the 20 is an intercompany. Then we have 15% redeemable preference shares, 15% redeemable preference shares. Just the same story. We don't have the one for Tamim and even PesaFlow, so we recognize the one for Mima, 60,000. It had not been acquired. Nothing else for non-current. So we have the current. Finally, we have the current liabilities. One of them is accounts payable. And we also have taxation. The accounts payable is the 420 plus 90. We have 50, and we subtract 80, the intercompany. For taxation, we have no much problem there. 65 plus 40. Plus the 35. Then we are able to get this. Then we get the total equity and liabilities. So I take my calculator and say we have 30 plus 50 plus 25 minus 20. This is 85,000. 85,000, I add 60. That's 145,000. Then we have 420 plus 90 plus 50 minus 80. I get the 480. Then we have the 65 plus 40 plus 35. That is 140. Then I have 480. We have 620. Then I take the 620 plus the 145 plus the 2487.2. I'm getting 32, 52, 32, 52, 200. So friends, you can see that's what we have come up with. We have consolidated and we have prepared a group statement of financial position in respect to horizontal structure, where we had a holding company with the 2 subsidiaries. We could have like 3 subsidiaries. We could have like 4 subsidiaries. So what we must have said is this: if you have more than 1 subsidiaries, it's important to prepare the cost of control for each subsidiary. You determine goodwill for each subsidiary. But for non-controlling interest account, it will be 1. Group retained earnings account will be just 1. Then you prepare a consolidated statement of financial position. Thank you very much for this session, and I welcome you for the next session when we'll be talking about vertical structure. The next example, illustration, the next lesson will also be very important for you as far as consolidation is concerned, for consolidation of a group statement of financial position. So please follow me and join me in the next session when we will talk about an illustration which will be longer than any other example that will be talking about a vertical structure. Thank you very much. May God bless you.